Today, I have the pleasure of talking to Gino Barbaro. And Gino, I apologize for butchering your last name. I thought I had it right. So Gino is from the sunny state of Florida. Gino and his partner Jake have built a portfolio of over 2,000 multifamily units and manage 450 million in assets. In our conversation, we discussed how to find deals and money, how to underwrite, and what to avoid. Plus, we also share many laughs along the way. Hello, and welcome to the Real Estate Baller Show. I'm V, a real estate entrepreneur from Houston, Texas, a mother and a dedicated health enthusiast. This show is about learning and sharing everything I discover about real estate investing with the goal of helping you achieve your financial freedom through various real estate investing strategies. If you enjoy our videos and found value in this channel, please do me a quick favor and hit that subscribe button. It helps us more than you know and allow us to help more people achieve financial freedom. Thanks and enjoy this video. I'm sorry for this interruption. I've been asked a lot about passive investment, and let's be real. There is nothing passive about being a landlord unless you have a really good property management company. So if you own an Airbnb or a short-term rental and you want to get back your time, please give our team at Buzz Vacation Rental a call at 281-549-8432 or go to our website at pm.buzzvacationrentals.com. Now back to the Real Estate Baller Show. Well, today we got a celebrity on the show. Hello, Gino. Welcome to the Real Estate Baller Show. It is so great to have you. In just probably 10 years in real estate, you have made a name for yourself as a true REBaller. And I'm really excited to have you here and to talk about your journey. But to kick things off, I want to start with something a bit personal but fundamental. So everyone has their own definitions of success, and it's often shaped by their unique experiences and goals. So, Gino, here come the big question. What does success mean to you?
It's a difficult question to answer because I think if you're being honest with yourself, as you get older and you have more experience, that word success constantly evolves. The word success to me 10 years ago meant becoming financially free. Well, when I became financially free, then I have to find a new barometer for success. And I think if you're asking me today what success looks like, to me, success looks like teaching other people how to become autonomous in their lives, to teach people how to become multifamily entrepreneurs. I guess create more impact for others, to have a day where I can sit down and I create and I enjoy what I'm doing and I can help others. That to me is success. To being a role model for my children, that's another form of success for me as well. Whereas where you're in different stages of your life, if I look back once again 10 years ago, that success for me would have been like, I need to hit 1,000 units. I need to hit 2,000 units. That's actually changed for me. And I think for anybody, they should reflect themselves and say, what did success look like for me 10 years ago? What did it look like for me 5 years ago? What does it look like for me today? And maybe what will it look like for me 5 years from now? So if I look at it 5 years from now, success would hopefully have a couple of my kids married, have some grandchildren. That would be really successful. I'd really love to see that. Success is to continue to be a role model and continue to create and perpetuate my legacy to my children. Not only the financial legacy that I've been able to build, but also the intellectual legacy, the values legacy, to be able to continue to push that to my children going forward. And if you had asked me that question about legacy 5 or 6 years ago, it really wasn't that much on the forefront of my mind, but now it really is. To see what's going on with this crazy world and to say we don't have any control or we don't have any responsibility is ludicrous. I have the responsibility to teach my children this business and to teach my children our values and to be able to continue that forward. So to me, success is also, I guess, perpetuating the legacy that me and my wife have built, and hopefully my kids will carry on the torch as they get older.
This episode is brought to you by Jet Lending. For over 20 years, Jet Lending has been helping real estate investors succeed. They offer 100% financing so you can be in at $0 at closing. I can always count on Jet Lending to fund my deals. If you're looking to fund your next deal, contact our friend over at jetlending.com. Man, that's very impactful. And I'm sorry that we kick off with just such a big questions like that. So I know that, you're busy, you do a lot of deals, and then you also have a podcast with your partner, Jake, but then you also find time to write 3 books. Mm-hmm. Tell us about that.
And you forgot to mention the best part of my life is I have 6 kids, and we homeschool
And
our
6 children, yes.
It's one of those things where you start out in life, you just write 1 book, or you write 1 paragraph, and then you write another book. And I think then you write another book. And for me, one of the things that I really need to work on for myself is trying to be a little bit more compassionate with myself, because I tend to beat myself up a lot. And I think a lot of people have that issue also. It's really great on the one aspect, because I can motivate myself to say, we need to write another book. We need to do another podcast. And that comes down to the success aspect of it. If you feel successful, is it really true success, or am I really beating myself up to get these results? Am I enjoying these results? And I think if you're not enjoying the results, then you're not truly being successful, at least in my mind. So for me, creating a cadence of accountability, having my daily huddles with my team, having weekly meetings with the team, really putting up quarterly priorities with the team and saying, hey, we need to write a book this quarter, we need to launch this website, whatever it is, picking 5 or 6 priorities and sticking to those priorities. Because early on, I would try to do way too much, get overwhelmed, start with something, and then never finish it. And I think the important thing for anybody, whether you're a stay-at-home mom like my wife is, or you're an entrepreneur, or you're working in the corporate world, really prioritize what it is that's important that you need to get done and stick with it until you're finished. And if you have trouble doing that, find someone that'll hold you accountable to doing that.
I think you touched on a few key points. I think I just put a name to this thing. I call it the Entrepreneurial Syndrome, right? We beat ourselves up, and then we also chase the next thing. We never really in the moment. And so I think your statement, what you said here, is so meaningful, that you said you also, go back to the moment and stay in the moment. So tell us, what is it like in a day of Gino? This episode is brought to you by National Real Estate Insurance Group, a national independent insurance agency specifically for real estate investors. I personally use NREIG for my investment properties. They offer a low monthly payment option to help you to lower your cash out of pocket when buying an investment property. If you're looking for insurance coverage for your flips or your rental, reach out to them. You can click on the link in the show descriptions, or you can reach out to Jules at 816-946-8443.
V, what you just said before I go into the life of day of Gino, it's not really that exciting or sexy, but what you said was truly important, the entrepreneurial syndrome. And this is a function of all of us. And if you're doing that, if you have that shiny object and you're almost there, and then you quit, and then you go to the next shiny object, I would challenge you. This is something where you can work on some type of personal development. And what I ended up doing was I ended up working with a life coach. His name is Philip McKernan. And sometimes you're doing things subconsciously or unconsciously, and you want to understand why. You don't know why. You quit. You don't know why when you make $1 million, all of a sudden you lose it. What's going on?
Yeah.
And I think some of us are afraid to go back into our childhood. And that's what I've done over the last several years, especially with my relationship with money. I was a great saver. I had this scarcity mindset. But why did I have that? And until I went back into my childhood and I heard the words that I learned, and I saw my family, how they reacted, and I heard those words as I got older, well, then I began to understand, well, when I got money, I could save it, but then it was really hard for me to enjoy it because I was worried about saving for a rainy day, having that scarcity mindset. So for anybody out there having that entrepreneurial bug or that syndrome, explore it. Go back. Take some time and work with somebody. have those discussions with yourself. Now, I don't want you to get stuck there for the rest of your life, because that's what a lot of people might tend to do when they're working in therapy. They don't seek the answers. You just want to see what was going on. You want to challenge those. Then you bring them to the present. Let's work on the present. And then you start asking yourselves, what does your life look like? What does success look like? And you build towards that. You want to try to remove all those blocks that you had as a child or as an adult or as a young adult. And it's a process. And it's working through those emotions is difficult. And Philip loves to say, doing the work is hard, but not doing the work is even harder. And
Yep.
I was of the type and the mindset that the emotions is hard. I don't want to categorize male, female, but for men, it's very difficult sometimes to actually work with our emotions, to be able to sit with our emotions, because I am more of a doer. I need to do something. I don't want to sit with it. I want to get it accomplished and move on to the next task. And that really works well until it doesn't work well. So I just wanted to share that with you. I thought that was really, really important, that entrepreneurial syndrome, because a lot of us have it. And just ask yourselves, why, when I get the job that I like, I'm always looking for another job? Or why, when I have this 20 unit, now I'm looking for a 40 unit, I can't enjoy it? Or why am I not pulling this task through? It seems like I have a block there. It's really important that you start looking back and diagnosing your life.
Hey, if you have any questions or comments, please leave them below. Well, so let's explore this. We're going off a little bit here. So let's explore
Yes.
what we just discussed for a moment. You know, I feel like if the listener listen to this show here, means they want to do something. They want
Yes.
to improve. They want to do, have a better life. That's why we started out with success, right? Because I feel like it's important to define where you want to go.
Yes.
It's like I say this all the time to my team, to people. You can't go on a run just to go running. You gotta, okay, I'm gonna go run for an hour or run for 2 miles, whatever that is. And then you run, because if we just keep running, we're gonna get worn out and we'll never know what it looks like, how it feels to accomplish. And so I totally agree with you and what you said, and I'm so glad that you circle back and redefine the entrepreneurial syndrome again. I think it's so important to start anything that way.
And I think to put a bookend on that and to really finish that thought, you brought up a great point. Ask yourself, what is it that you want? I always struggled because I always was asked that question. And when I was asked that question, I was very simple. When I had my restaurant days, I would say, well, I don't want to be at the restaurant. But that's not the question that somebody asks. What is it that you want? Okay, and why is it that you want it? Once I understood that I wanted to invest in real estate, I wanted to find a partner, and I wanted to really, scale that business. Once I understood that's what I wanted, I could focus on it. I had clarity to achieve that objective. Until then, I was just confused. I didn't lack motivation. I lacked the clarity. And when you don't have clarity, you won't have the motivation to achieve your goals.
Yeah, so you and I share another thing in common. We're both immigrants. And so we never lack the hardworking aspect, right? We work our butt off. So
Yes.
that's how we were taught, and we always want more, more, more.
So V, it's interesting that you bring that point up, because if you think about it, that's a learned skill. And for me, working hard was great, but is it always the right thing? All right, maybe working smarter may be better as well. I was I'm a guy. I'm going to do this. I'm going to do that. And when I had my one restaurant for over 20 years, it was me in the kitchen washing dishes. And when I understood that I was going to get burned out, and I learned it's not just about working hard, it's about working smart as well. And understanding that aspect of it, to become an entrepreneur and want to scale a business, not just to scale a business to make more money, but to scale a business to find the skill sets and the things that you love, that you can accomplish. For me, it was the education platform. For me, it was teaching others. That's what I loved. And for me to be able to scale the real estate portfolio, it allowed me to slip into this role. So I think that's the other thing. That's part of success as well. Finding out what you really like, finding out what your sole purpose is, finding out all of that, and then trying to work towards that goal or that objective.
I think I already picked up a few nuggets here just listening to you.
Thank you.
Okay, so started off the show, I said we're going to be fundamental, basic here. So now let's take it to where, imagine I'm 30, I don't look that young, but I'm 30-year-old, working a full-time job, and I've managed to save $20,000. So someone like me, I want to get into commercial real estate. That's what you do. And finding the right deal is crucial. Not losing money is crucial. Building wealth is crucial. How do I go about finding a good deal, especially in today's market?
The first thing I would do is I wrote a book called Baby Money Soldiers. And if you're 30 years old, you need to understand how money works. And a baby money soldier, I have $1 right here. You've saved up that money. Every dollar that comes into your life is what we call a baby money soldier. How you allocate or use that money will dictate how well you do in life. And let me give you a perfect example. You, as the person in your life, are the general of your financial battlefield. Mm-hmm. We're always looking to get into the next deal, to get into the highest rate of return. I think that's the wrong mindset. I think first and foremost, we have to understand how to control our baby money soldiers. You could be making 7 figures and be living paycheck to paycheck. It has nothing to do with how much you make. It's a component of being able to save enough baby money soldiers where you can go out and you can deploy them into buying an asset, right? Or even into putting the money into the stock market. Whatever vehicle you choose, before we get into the real estate, it's important that you lay the foundation, because this is all foundational work, especially if you're 30 years old. You need to understand that you need to save a certain amount of money to buy an asset, to pay for an event, not to save money to pay for the event. I was trained from the middle class to go out and put money into a 401k to save for my retirement, a 529 plan to save for my kids' college. When I understood the inefficiency and the waste that there was in that, and I said, let me save money to buy an asset like multifamily that will pay for the event. When that event is over, like a college education that I paid for, I still control that asset. That's the first important thing. Learning the rules. I can't go through all the rules in the book. It's a short book. It's like 50, 60 pages long. But understanding that, creating that foundation, you have that money. Before you even go out and look for a deal, make sure you understand that you are putting aside a certain amount of money to continue. Before you even allocate any of your money into a deal, keep some of those baby money soldiers in reserve, in an emergency fund, in case something happens. Another event like COVID where you may have to take off of work or you lose a job, have some of that money set aside. Make sure that your credit cards and your debt are not killing additional baby money soldiers. So making sure that you don't have any additional debt. See, I'm not even talking about investing anymore. We need to have the foundation set and secure before we go out and take all that hard-earned money and go invest it into a deal. Now, before you invest into a deal, you better get on podcasts. You better listen to books, read books, listen to audibles, whatever it is. You better consume and educate yourself for a minimum of 6 months. That's what I would say, at least 6 months. I mean, when I started, it was a lot more challenging. There weren't a lot of mentors out there. At that age, also, I may want to invest some money in a mentorship group. I mean, I made a ton of mistakes. Remember, I was just talking to you off camera about life before Jake and life after Jake?
Yeah.
Life before Jake, when I invested in myself, I had no mentors. When I lost a ton of money, I decided to find the mentorship group, and I invested actually in 2 mentorship groups. So I understood it's not just education, it's implementation as well. You can go out and watch all the YouTube videos you want, but if you don't have somebody holding your hand and helping you implement what you're learning, it's crucial. So now that you have this money, invest it in yourself. And those baby money soldiers, an investment in yourself is a way for you to actually get a huge ROI. And what does that look like? Early on, I may go into a little bit of like personal development, life coaching. I may go into, let's say, a single family home portfolio where I want to learn how to invest in single family homes or multifamily. I think what's important when you're starting out, once you've learned these fundamentals and you've built the foundation, then choose the vehicle. I'm here to tell you that multifamily, especially when you're starting out, small multifamily, duplexes, quads, they're a phenomenal investment. You can get in as a residential investor on these smaller assets. If you're 30 years old, you may want to buy a duplex or a quad, live in one of the units, house hack, and rent out the other 3. I would absolutely do that. That's how us as immigrants, we did it. My mom moved to Italy, came from Italy. We lived in a duplex with my aunt. We rented it downstairs. My mom lived rent-free for 15 years. And all those savings that she made, she was able to save and to put into other assets. So if you're young and you're 30 years old and you want to invest in real estate, understand and learn the commercial aspect of it. And then possibly go out there and buy a deal and live in one of those units.
I feel like as immigrants, we are house hacking, but we didn't even know it's called house
Yes,
hacking.
yes,
You know,
yes.
isn't that amazing?
You
The
know why, V?
concept,
Because
yeah.
we're not marketers. We also had side gigs. We also called side hustles. We call them second jobs and third jobs. They're not
Yes,
side hustles to us. So it's very interesting how we've all done it, but we weren't smart enough to market it the way they market it today,
that's
right?
right. That's right. Yes, I still remember like back in the day, it was an article in the news like we got a room to share, you know.
I love that.
Okay, so obviously I was able to save up 20,000, so I'm somewhat disciplined, right? But what you're telling me to do is maybe spend the 20,000 on learning self-improvement. Is 20,000 enough to go get in a deal? Is it not enough? Do
Great
I need to
question.
build
It,
up
it,
more
it, it
asset?
depends on the deal itself, but I'm just talking from my personal experience. I saved up $172,000 back in 2005.
Yeah.
No mentorship, no understanding of real estate. I invested it with a gentleman. I like to call him Maserati Mike because he drove a nice gold Maserati. 18 months later, I lost it all. And Tony Robbins always poses
I
the
went to his
question.
Maserati?
Yeah, well, I don't know what he did with it. He drove away. I never saw him again. You know what I'm saying? And that's the reality. But Tony Robbins always says, do you need to make the money and then go to the event and to learn how to make money? Or do you need to learn how to make money by going to the event and then you'll make the money? I really think if you have $20,000, you need to allocate a certain percentage of that to learning and to personal growth and to personal development. Because don't do what I did, have a nest egg worth of money and just invest it in a deal, looking for a deal. I didn't even know what a deal was. I didn't know I was a passive investor. I didn't understand due diligence. I didn't understand the basics of underwriting, cap rates. And it was my fault. I can blame Maserati Mike all I want, but at the end of the day, I stroked the check. And after 2 or 3 years of that experience, I needed to take responsibility for that. So I'm telling you this right now. As a young investor, don't be looking for a rate of return. Don't be looking at Bitcoin and saying, oh, I'm going to throw money in Bitcoin and just worry. You have to understand and learn how to trade Bitcoin, right? That's the important part. I'm not telling you what vehicle to pick, but whichever one you end up picking, you need to be really, really exposed and really understand it. And if you're in real estate, obviously one of the bigger places to go look at real estate is Bigger Pockets. Go on there, read the forums, see what's going on, understand they've got a really huge, vast resource of blogs, articles, books, and I'm not advocating them or not, but if you're starting out, it's a great place to go and to find out, and then just start YouTubing and start Googling multifamily, Google single family homes, Google investing, and you'll see other people pop up. Start following them and start consuming their content as well.
Okay, let's redirect out here for a moment since you brought up the social media. You know, in today's world, we obviously have abundance amount of information at us. So I'm navigating. How do I stay clear? Or, you know, does it matter if I come across some bad information? How do I know if it's good information versus bad information? You know, noise versus
Yes.
legit.
That is probably the $10 million question, and it's very challenging. As you're going on, you're seeing people claiming that they own 10,000 units and they've got Lamborghinis, and that's attraction marketing. That works for a lot of people, but if you're a serious investor, start listening to other podcasts. Start listening to how people talk, and then success leaves clues. And I think you as an investor, if you want to learn more about Jake and Gino, I have 4 podcasts. You can go listen to my Movers and Shakers podcast. I've interviewed 160 of our students who have closed deals. Our students have closed over 80,000 units. They've done over $5 billion in transactions. So when you go on ours, we're obviously not a scam. We've been doing it for 7 or 8 years. You have to look at a person's track record. You have to be able to resonate with them, right? You have to be able to see what they're offering. Are they still doing it? Our primary business is not education. Our primary business is investing. We're closing 3 deals in the next 90 days, and we have an education company as well. You have to make sure that if you're going to be investing in your education with an educator, that they need to be continuing to do it. We like to call ourselves actually the gurus, not the gurus. We're the gurus because we're doing it. We're constantly doing it. And we've been doing it since 2011. And that's one thing that distinguishes somebody who says they have the results versus somebody who's doing the results. That's what it is. I don't have the marketing of having the side hustle. And what else? What was that other thing? We're not the great marketers. We're just people who are out there working every day and just taking those learnings that we've learned and able to put it into the community. So if you're out there trying to cut through the noise, pick the niche, pick somebody who you like, who you can follow, see if they're constantly doing it in this part of the market cycle. And then if you resonate with them, join them.
That's awesome. That's great advice. So I think you led me to another point earlier, part about me, this 30-year-old fighting deals again, the underwriting. You said the word underwriting. So I think learning to underwrite is important. Can you share how you underwrite a deal?
It's interesting. It's a great question. And I would start by saying that you need to understand basic accounting. I mean, I sent my son, he's second child, to college just because I wanted him to get an accounting degree and a finance degree. I wanted him to understand statement of cash flows. I wanted him to understand the trailing 12. And I wanted him to be able to understand debits and credits, balance sheet, income statement, rent roll, all of the basics. You need to understand some of the basics. And you don't have to be an accounting major to learn all that stuff. But you need to have a group like us that can teach you that stuff. And once you understand that, as far as the underwriting goes, it can be challenging and daunting if you haven't done any kind of financial modeling. It can be, but it's such an important skill for you to learn. And we have underwriting templates and we have training videos and tutorials. But once again, the foundation has to be built. You have to understand that multifamily is a business and you're buying a future stream of revenue. That's what you're actually investing in more than anything else. If you can extrapolate that, because you as a 30-year-old are probably saying to yourself, I need to buy this building because it's real estate. Whereas the 50-year-old is saying to themselves, I need to buy this asset because it's going to be a business that generates cash flow and it's going to appreciate. So there's the difference. So when you're learning underwriting, learning those, the rent roll, T12, statement of cash flows, and then learning, obviously when you're going income versus expenses, NOI, the debt side of it, you're going to have to learn all of that.
Well, I took accounting class in college one time, hoping to get an easy A, but it went the other way.
They're not easy. They're hard. They're difficult classes. I hate accounting too. All the debits and credits and it's painful. It can be painful.
It was so painful. But I do understand the balance sheet and the P&L.
And V, it's interesting. What I would say to anybody who struggles with that, this is something that I do with my children. We play that board game by Robert Kiyosaki, Rich Dad Poor Dad, the cash flow. That cash flow game is really very instrumental in teaching people about a balance sheet, about an income statement, about simple investments, about trying to create passive income. I mean, it's not going to make you a better underwriter, but once again, for someone who's in their 20s and 30s who doesn't have that foundation, it's a great game to understand. Wow, I'm a doctor. I'm making $12,000 a month in income, but why are my expenses $9,000? It's because doctors live a higher lifestyle. They're killing a lot more of their baby money soldiers. Whereas when my kids play, they want to be janitors because janitors have lower income, but they have much lower expenses, so they need a lot less passive income to get out of that rat race. So understanding that mindset changes a lot of things for you. So that game will absolutely help you out by learning what balance sheet is, what an income statement is, and also just basic investing skills.
That's awesome. I'm going to start playing that game with my kid, but I have a bragging moment here. So we were in the car. I take my daughter to work with me, when we go see houses and things. Yeah. And I would ask her, I said, you make $3,000 a month, but then you want to spend $5,000. What are you going to do? She go, I just go make more money. I'm like, okay. I love that.
That is exactly, so your daughter must have heard that from somewhere. She has the abundance mindset, whereas some people might hear that and go, well, I've got an expense problem. Let me cut my expenses. Whereas your daughter has the abundance mindset and says, oh, no, I can go out there and make more money. It's not a budget. It's a spending plan. So for me to spend more, I've got to make more. So you're already training her to think with that abundance mindset. Good on you. That's awesome.
Thank you. I'm very proud.
Yeah, you should be.
All right. So now that I got through fighting the deal and underwriting process, how do I get the fund?
Great question. You're talking what our framework is. It's buy right, manage right, and finance right. When you're younger, it's more challenging. I mean, they have FHA where you can put down a certain percent, 2.5% or 3%. I don't really even know what programs they have currently, but first-time home buyers as well. And if you can't do it by yourself, what about partnering with somebody? What about bringing in some funds? Do you have any money in a 401k plan that you can tap out of? Do you have any money saved away in a 529 savings plan? Do your parents, if you're lucky, have a whole life policy on you with some cash value? Maybe you can borrow some of that cash value from your parents' whole life policy and put it into a deal. For me, when you're younger, it's very, very challenging to find the finances, but that's where people focus and they stop. I mean, when you're young, what about learning the tool of syndication, where you're raising funds from somebody else? Remember, it's not going to happen overnight. There's a lot of education involved, but that's what stops the majority of people when they get into real estate. I don't have the money. I can't do it. Jake and I bought an $11 million deal in our third year together, 281 units. It was seller financed by the seller, 20%, 80% by the bank. We brought $0 into that deal.
Yeah, because if you were to bring in the down payment, that's 20 or 25% that you were required to.
Exactly. And the seller carried that 20% as a seller finance note. So we did not bring any money down. So as you're young, you need to understand the creative aspect, which is seller financing. You need to possibly learn what a master lease option is. Right? Master lease options are going to become much more prevalent in this part of the market cycle. Also, the syndication model, where you're raising money from other individuals to be able to do that. Then you have private money loans, you have hard money loans, you've got grandma, you've got grandpa. Be as creative as you possibly can be. But remember, if you're going to go out and ask anybody for money, you need to be able to show them that it's a good deal, that they're investing not only in a deal, but they're investing in as you. And you, as that young adult, needs to understand that you're the financial fiduciary for that asset, for the deal that you're putting on the contract. So you have to provide value for the person that's lending you the money, the person that's giving you the money.
So Gino, is it harder to find the deal or the money?
Good question. It depends on the market cycle. When Jake and I started back in 2011, there were deals everywhere. LoopNet was filled with deals back in 2011, 2012, 2013. You couldn't find the money. It was very challenging. Debt was getting much more difficult. Raising capital back then was a lot harder, but there were deals. And now, as the market cycle lengthened, all of a sudden seller financing went bye-bye. You don't need to be creative. Anybody can sell a deal. Syndication came out, tons of money flooding the market, and the deals became more challenging. Now, as we're entering this part of the market cycle, I'm seeing that debt's pulling back a little bit more. Debt is becoming a little bit more challenging. I'm seeing that creative financing is rearing again. It's going, wow, we've got some seller financing. And you're seeing it as you're driving around your neighborhoods. Seller financing available, seller financing available. So that means that debt's becoming harder. And there's not enough supply in the market yet. But once supply starts ramping up with these opportunities out there, there will be deals. It may be more challenging to find capital, especially if you're more of a retail investor, because the LPs, the passive investors, a lot of them right now are having capital calls, maybe some foreclosures, maybe their equity's been wiped out. They're not going to jump back into the investing pool. They're going to sit back. So a lot of these syndicators are going to have challenges raising capital. So I think it's a function of the market cycle. It never really aligns where, hey, I've got a ton of money and I've got a lot of deals. It's either I've got deals but not as much funds, or I've got a lot of funds and not as much deals.
They don't ever line up perfectly, do they?
Nope, they don't.
Okay, so what should I avoid? What are the things I should not do when it's come to looking to invest my money for a 30-year-old?
Wow. Look at it from the lens of the buy right, the manage right, and the finance right. When you're investing your money, two words are crucial in buy right. It's called due diligence. You need to understand what you're looking at. There's three parts of due diligence. I think I would break it down into the financial aspect of it. You'd mentioned underwriting. You'd mentioned looking at the numbers. Make sure that financial and those numbers make sense to you. I think the next part is the physical aspect of due diligence. We have inspectors go out to our properties now. We have our whole CapEx team go out. We have our HVAC team come out. We have plumbers going out scoping lines. That's the physical. Once those two are great, the third component is the legal aspect of it, making sure that there's proper CFOs, making sure you have the proper certificates there, everything's in compliance, title insurance. So you need to really work on due diligence, number one, as far as the buying criteria. And I think taking a step back further, when you're an investor at 30 years old, most people don't do this. Most experienced investors don't even do this. Understand what your goals are with buying a property. Just don't buy a deal because you think it's a good deal. Really stop and think, what's a good deal for V, what's a good deal for Gino, and what's a good deal for a 30-year-old? They're vastly different. So understanding what the goals are to investing in that asset are really important. Creating your buy right criteria based on what your goals are is really important. And then obviously we discussed a little bit of the finance aspect. And then the manage right when you're buying a smaller deal, it's not as prohibitive because you're only dealing with one or two or maybe 3 units. But still, you need to understand leases. You need to understand contracts. You need to understand a little bit of dealing with residents. So that aspect of it, we can't forget about that one as well.
There's so much to learn.
There is not
But
enough time.
And I think in our half an hour discussion now, I feel like you have really narrowed it down to whatever it is that you want to do. You just really got to focus on what do you want to produce, right? What the outcome would look like. It's like you said earlier, what's the good deal look like to you? Like if it's perfect, what would it look like? Is it because you're gonna make 100,000? Is it because you're gonna own this beautiful complex? Whatever that is, your advice is to take a moment and really picture that. Write it down. Maybe post it on the wall to remind yourself so you don't stray out of your box.
And V, I would take it one step further. You can do that, but it's also important to understand what your values are. So all of your decisions should be based upon your values. We call it values-based decision-making. And, if you don't know what your values are or you think you may not be
emotional, because that's where you that's where you can lose money, right?
Exactly. But I'll give you an example. For me, multifamily works really well for me. I'm responsible. I like control. I have a long-term mindset. Those all fit really well with multifamily. And those are my values. Every decision I make is based on those values. So for me, investing in Bitcoin and trying to trade it and trying to make a couple points on Bitcoin is not really going to bring me value.
You don't like that instant gratifications like most of us do?
Yes. Well, I mean, instant, but it's fleeting. I don't want the dopamine hit. I'm just saying, for me, that doesn't align. So for somebody else, that may be their persona. They like taking risk. They like having a lot of fun with investments. My values are different. And I think if people want to really understand what their makeup is, understand what your values are, and every decision you make, whether you're marrying your spouse, whether you're taking a job, whether you're investing in an asset, whether you're buying a home, renting, car, whatever it is, make it based on your values. And if something feels off or doesn't feel right, subconsciously or unconsciously, it's not really aligning with what you believe or what you value.
It's so important. I agree with you. You say make it around your value, and I also use the same analogy. Build, businesses or everything you do around your strengths, your weaknesses, and your core values, right? So yes, it's so important. That leads me to the next question. Do you see a correlation between multifamily and single family, market cycle?
That's a great question. As far as correlation, I would correlate them in the fact that they should all be run as a business. I think the problem with the single family home space is there's a lot of mom and pops, and there are in multifamily, but they view it as, I'll be buy 1 or 2 or 5 or 7 and not really think of it as a scalable operation. They have very little systems, and this is just from my experience. I've dealt and spoken to a lot of people in the single family space that end up joining Jake and Gino, and I see the differences. And there are also people in the multifamily space that are mom and pops, but the multifamily space lends it more towards systems and processes, and it is easier and scalable. But I think if a single family home investor does it, and I've met a bunch, I met a couple. I actually spoke to one yesterday who has, I think, over 300 single family homes, and they keep buying them. But he has processes, he has systems, he has this third party property management running the asset, right? And he's got investors and he's raising capital. So it's very similar and complementary. Right? At the end of the day, they both should be run as a business. They both should be following the buy right, the manage right, and the finance right, because you should buy a single family home properly, you should finance it properly, and once those two legs have done, or the wheelbarrow that we call, you should always be managing it. Now, as far as I'm trying to think of the correlation between market cycles, great question. In 2022, multifamily peaked, down 22% since then. Cap rates have been decompressing slowly. It's interesting to think about single families, what's going on. I think also from a national perspective versus localized, they're both very localized. Because down here in Florida, there's still a lot of demand and not as much supply.
Yeah, I think the real estate is actually a local market, investment. It's market to market. My saying is the national articles and that's for selling clicks and views. We always have to look at it from the local. And the reason why I ask that question is I see this often. People who come into single family because they feel like that's where they have to start.
Yes.
And then they get a few deals under their belt, and then they go, okay, I got to graduate to multifamily. So a couple years ago, we saw a large amount of people from single family want to go do multifamily. And then now we're seeing people from multifamily jumping back into single family. So I was just curious that with your knowledge that if you can see a correlation to see like if one go up, the other goes down, or, if they have any relation at all.
I think the problem is that people don't understand there's a couple of big differences between multifamily and single family. One of them is in multifamily, it's not an MLS-driven market. You need to create relationships with brokers. That's the reality. You could do some off-market deals, but the vast majority of them, you're not calling up a 30-unit owner and saying, hey, can I buy your... That doesn't really happen as much in multifamily. Understanding that is one of the benefits when you get into multifamily. You can reach out to the brokers and create relationships, and that's where you're going to get deals. Whereas in single family, you're on MLS, you're on Zillow, you're on Realtor.com. You can get more deal flow that way. And the second component to multifamily versus single family that's different is the debt side. Whereas in single-family residential, the mortgages are 30-year, they're amortizing for 30 years. Whereas in commercial, some of them, the vast majority of them, have a term on them. Whether they're 5 years, 7 years, 10 years, they balloon or they reset. And understanding that component is, I think, one of the reasons why people get into multifamily. They don't understand those two components, then they jump back into single-family. I would just say whatever niche you like, learn it and stick with it, because I don't think one is any better than the other. This gentleman I spoke to yesterday, his name was Paul. He loves single families. He's trying to bring that nationwide where he can start doing it in different markets. My only thing is it's very challenging to buy 7, 10, 15, 20 deals a month when I can buy a 30 unit and have one transaction as opposed to having 30 different transactions. I think that starts to wear on you. And once you realize, wow, I can do a 50 unit and not have to do 50 single-family homes, and I could do 2 transactions a year while that person's doing 90 transactions a year. Who's going to be more profitable in the long run? I mean, there's a lot of effort closing all those deals as opposed to just trying to close 2 or 3 deals.
Yeah, the scalability of single-family home, which is why I believe we don't have many big-time, national single-family home, right? They end up being like funds, Another questions on the multifamily front. I'm not speaking against syndication. However, I feel like also a large amount of syndications has failed over the last few years. What are your thoughts on that? Why they fail? Could they have succeeded otherwise if they did X, Y, Z?
Syndication is a phenomenal tool when you don't have the capital and you want to scale into larger multifamily. We've done 3 syndications. We bought 2 in 2018, 1 in 2019. We've since exited all 3. So all the deals we own right now are just owned by me, Jake, my partner Mike, and a few other investors in those deals. The vast majority is ours. So we don't have any more syndications. So for me, I love the syndication model for you to get into multifamily, for you to scale. And if you have the ability to create another business, you have investors. Right, you have the asset, and all of a sudden now you have investors. You're creating asset management fees, you're creating acquisition fees, and you're putting deals, and you're getting deals done, and you're creating equity on the back end. So I love it. Now, what did they do wrong? Well, they all got into the business. You have doctors groups, dentist groups who are all raising money, but they don't know the business of real estate. They forgot that it's like having a child. You have to raise the child. You have to take care of your buildings. And that's one of the biggest mistakes. Operations completely went out of the window because people were making money on cap rate compression and they didn't have to, increase NOI at all. When that came to an end, it's like, oh, well, rents are not going up anymore and my expenses have doubled. What happens? I think the real big problem was that third component, that finance right. There's a lot of short-term bridge financing when people shouldn't have been using it. Short-term bridge financing is another great tool when it's utilized properly with people who have experience, who have a business plan that can get that business plan done at a certain period of time. A lot of those people didn't fall into that bucket who took out bridge financing over the last 3 to 4 years, and now they're seeing the repercussions of it. We're paying over the last 3 years deals that were stabilized. We're using bridge financing on stabilized assets. That should have told people right at the end of there that we were in a bubble. But money was so cheap There was such an influence, such an influx of it. It just went to find assets, and multifamily was one of those assets. Prices were bid up with the expectation that rents were going to continue to rise. And that's what we've seen. We've seen those mistakes. But now, as interest rates have risen, we call it a market cycle. It's also an interest rate cycle. And to bring back the point of single family versus multifamily, when interest rates rise, it has an effect on the overall real estate market. It takes a little bit of time to seep into it. Now you're seeing what's going on with mortgages. There's mortgages in single families have really dropped. The demand has come down, where you're seeing supply come back into a lot of these markets in single family. Now multifamily is going to follow that route as well. But as far as those mistakes, what we've seen over the last couple of years, now it's coming to a head, and you're going to see a lot of these syndicators who have these deals are going to either have capital calls, or they're just going to have to sell their assets at a loss.
So sad. It's all about due diligence, right?
Yes. Mm-hmm.
Okay. So I'm sure you know about this. I'd like to hear your thought on that. Rent cap.
It's interesting. It's not a way to solve the problem. I can completely understand bringing it out 3 months before an election. I get it. People who are not financially intelligent. My whole slogan is people with financial intelligence can change the world for the better. That's why you need to understand this. And if you understand basic economics, let me cap rents at 5% for assets that are not building. So you're already talking about assets that aren't building, for units that are 50 or more, so the vast majority of the units that are owned, and I'm going to cap rents at 5%. So what that's going to do is you're going to get everybody to raise rents as quickly as possible. You're going to get people to get evicted out of their properties because they can't raise rents. So you're going to get certain states where you're going to get evictions. You're going to cause an even more of a problem, right? There's so many different unintended consequences of that. And oh, by the way, if I'm in Florida and I get a hurricane and my insurance goes up by 30% and my property taxes go up by 20%, are you going to cap my expenses also? They don't think these things through. The real solution is to create more supply. That's the reality. And it's been done in certain municipalities. I know Minnesota, certain cities in Minnesota where they've changed zoning laws, and even California is, using additional dwelling units, those ADUs, because they know that's the only way that you're going to get rent relief is by bringing more supply on. The more supply there is, it'll tackle the demand. Pricing will come down. It's really basic ninth grade economics. But that doesn't sound right. It doesn't sound good as a slogan. I'm going to cap the rent on the greedy landlords. Well, the majority of the greedy landlords, they're mom and pops. They're the ones out there trying to get it. And then what's going to happen is they're going to leave the market, and they're not going to be able to take care of their properties. So when the resident wants something fixed, he's going to say, hey, your rent only went up 5%. I can't afford to fix your apartment. And there's holes in the driveway, and there's a hole in the roof, but I can't fix it because my income is only going up 5% a year, where my expenses are going up 20%. So as you can see, I'm not really a big fan of that. Let's tackle the problem. Government's really great at creating a problem and then creating the solution, and then creating another problem from that problem, and then trying to create another solution. Ultimately, the solution is to incentivize people to build and to change these zoning laws where we can bring more supply into the marketplace.
Somehow I feel like if we run our businesses the way the government will be out of business.
In 6 months. You won't even last 6 months.
Probably not.
No way.
Unless we have a printer that can print dollars.
Yeah, well, then you and me would be in jail if we did that. They can do that, but we can't, right?
Yeah. All right. So, Gino.
Yes.
What advice would today's Gino have for 18-year-old Gino?
I really wouldn't change anything because I love where I am right now in life. But if I was that 18-year-old Gino, what I would tell any 18-year-old right now is to learn a few things. Learn, number one, about nutrition and health. Learn, number two, about mental health. Number three, I would learn about finance and understand money, understand how money works. If I was a 30-year-old or a 40-year-old, I didn't understand what fractional banking was. You think that would have helped me when I was 18 years old, understanding how the banking system works? Absolutely. So, yeah. And that's for all you parents out there. Teach your children about money. Be vulnerable about money with them. Let them learn from you. Don't let them learn from the school, because the school is not teaching them. So for myself as an 18-year-old, I would say, don't worry about the beautiful car. Don't worry about the big house. Save to buy an asset. Let that asset pay for those expenses. And if I had done that sooner, I would have been financially more, I guess, qualified, or have reached financial freedom sooner. But for me, as my children, I'm just trying to teach them to become financial stewards of their money, and understanding that they're saving their money to buy assets to pay for their lifestyles.
That's a wonderful advice. Okay, so here's the last question of the day. I'm sure your phone gonna be ringing off the hook here. How does the audience get in touch with you?
Well, you want to give my phone number? I've never done that on a podcast, but
I'm
I'll do
just
it.
joking. You can give
I'll give them
phone,
I'll do it for you.
email,
V,
social media.
I'll do it for you. It's 914-522-3041. And yes, I do pick up my phone. And if you want to email me, it's Gino at jakeandgino.com. Just go to the website, Jake and Gino. You'll see the podcast there. You'll see the articles there. I love the show. Me and my wife do a show called Julie and Gino, so you can go to the Julie and Gino website as well. We do on families, we do on communication, working with your spouse, all the things that an entrepreneur needs, because we're chasing after money, but ultimately what I think we're really chasing after is significance, is relationships, and really a better connection with our family, with our spouses.
Okay, and where do people get your books?
Oh, just go to jakeandgino.com. All the books are on the website.
My biggest takeaway from Gino is educate yourself and then take action. So if you enjoy our videos and if you found value in our channel, don't forget to like, subscribe, and share this episode with a friend. By the way, hit that notification bell to stay updated with more amazing stories from our real estate ballers. Thanks for watching and see you in the next video.